Hey everybody, my name is Kyle Knott and I am not your average finance guy. For those who've been following me for a little while know that I'm kind of into real estate investing, and on the board behind me there, I've got two different scenarios. Um, I know $100,000 is a lot of money to some and it's not that much to others. So just throwing this out there for a regular example to take a look at. If you kind of follow the Dave Ramsey method, $100,000 to invest, he would say mutual funds and do that forever. And he claims you're going to get 8 to 10% every year on year forever. But we all know that doesn't happen. But let's just look at these two investments, that what the power of this is. So if you buy a mutual fund, and let's assume that both of these investments gain 10% over the same time period. So whether that's 1 year, 2 years, 5 years, 10 years, whatever, let's just say that in this snapshot that they both perform evenly and the same, which I don't think is too far off. I mean, when the stock market goes down, it doesn't really affect real estate too much outside of the '08 crash, when yes, there was a downturn, but if you look at it now back in 2025, everything is rebounded and it's taken off way past then. So I think over the long period, to me, my crystal ball says real estate will continue to grow over the long term. I think at a more reasonable, predictable rate than maybe the stock market. So the stock market will probably keep going, as well over the long term. Will probably still keep going up, but to me, it's just too much a roller coaster up and down on the daily basis. And these Trump tariffs, they're on again, they're off again. The stock market's going crazy, it's going nuts. I do have a couple bucks in the stock market I kind of play around with, but most of what I've got is in real estate. So just look at real estate. So if you can get a 10% return on both of these investments, your mutual funds after this time period will be worth $110,000. Well, if you can go and you can take the $100,000 and you can put 25%, make a 25% down payment, and you can buy a $400,000 house with that, or a fiveplex, or whatever kind of rental property you want. Now let's just assume that you have this money and your tenants are paying everything. You're not cash flowing. You're cash flowing exactly zero. Your tenants are paying all of your bills, and all you did was you took $100,000 and you bought this property. So it's not going to require any more capital outlay from you. Obviously every month it's going to go up and down a little bit, but let's just assume that this is a flat, break-even, cash flow neutral rental property, which I wouldn't really buy. I would make sure I've always got positive cash flow, but we'll put that to the side now. So in this time period, if that property that you bought goes up 10%, what's it worth now? It's worth $440,000. Okay, $400,000 with a 10% gain is $440,000. $100,000 with a 10% gain is $10,000. Now, what did you put into it? Both of these scenarios, you put $100,000 of your own money into it. But this is the power of using leverage that we do here. Now, I know I've got some videos that I kind of say, let's get away from the banks altogether. And I think with the IBC policy, with those loans, that's the ultimate goal. But hey, let's use it while we need to. Let's get things building, and then later on down the road, after maybe we can do some other things and we can build things back up. There's other options that we have, but this is just for an example. It's a super simple example to show you what a 10% gain on either one of these, where am I at here? Either one of these investments can do for you. So would you rather have a 10% gain? Would you rather have $10,000? I can't point right, it's all backwards. Or $40,000? I'd rather have $40,000. Okay. Now along the way, you're going to get principal pay down here as well. Your tenants are paying that $400,000 down. In 30 years from now, if this thing goes up in value whatsoever, you've got all of that appreciation, and in 30 years from now, you owe zero on it because your tenants have paid it off. So then what's it worth? Maybe at that point it's worth a couple million, and you could do either a cash out refinance on it, and you could put another mortgage back on it, or you can just enjoy the cash flow. Hopefully by then rents are way up there and you can easily retire and just live off of the cash flow of literally one property. Might do it. So I've got a couple. I want a nice fancy retirement, but that's my goal. I'm going to hold these things forever, and I'm letting my tenants pay the mortgage down. And whenever these things come due, where I no longer have a mortgage on them, it's just that much more rent I'll have in my pocket. I don't have to worry about paying the bank. I've got my IBC policies, and I'm kind of thinking right now, like if I can get it built up big enough, I've got one property where it's actually on a 5-year fixed mortgage, and then it's adjustable after that. And with the mortgage rates being a lot higher than when I bought it 5 years ago, 4 years ago, so I've got one more year left. I'm kicking around the idea I might just pay that off. And by paying that off, then I'll have no more mortgage to worry about. So there's another, I think that's just over $1,000 a month that I'll have as more cash flow coming into my system. And then I can use that extra $1,000, and what I'm going to do is I'm going to build that IBC cash value right back up to where it's at. Once I get big enough, maybe I'll buy something else that can bring some more cash flow, or I can pay something else off, which, could maybe free up another $1,000 a month of cash flow too by not paying a mortgage. So you've got a lot of choices. You've got a lot of different ways that you can do this. So just wanted to quick and dirty show 2 different ways. And I'm not going to lie, okay? It takes a little bit more work. Not a lot. I mean, I've been doing this for a while now, and this is my bread and butter. I know how to do it. I love doing it. But that first one, it took a while, and it took a lot of research and to know what I was doing. I wasn't sure what I was doing, but I tried it. I did it. I learned from my mistakes because I didn't do it all perfectly, but you never will. So just try something, get out there, do it. I've got more money coming in, and boom, I pay stuff off, or I buy more, and it just keeps rolling, and it gets bigger and bigger. You've got options. You can help people. You can do whatever. When you've got money, you've got options. Okay. So that's what we're trying to teach here. And they don't teach any of this stuff in school. All right. The easy button is just put it into some mutual funds. Maybe it's your 401k, and just forget about it. Let someone else worry about you being wealthy. And yeah, you might be 10%. I mean, 10% is really good in most cases, but real estate, no, we're looking at like 40, 50 plus percent. But to me, there's a lot more opportunity, and it's way better to build more wealth in real estate. I was actually reading something the other day that I don't remember. I think it was like 70% of millionaires in the United States in some way, shape, or form have real estate in their portfolios, in their investment portfolios. So I definitely look into that. And there's other ways you can do it. You don't have to do all this yourself. There are other syndications and ways you can kind of group some money together, and you can go off and you can like buy stuff with a group of people. But at that point, you don't have control of it. Someone else does. I've done that before, and they've not worked out well. I've lost quite a bit of money on some of those. So just word to the wise, caution on that, but just want to get you thinking about 2 different ways that you can build wealth. And I hope this helps. Let me know if you got any questions. Thanks, everybody.